For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
And thank you, or thank me. It is Managing Your Financial Future. Welcome back to the podcast. Johnny Dean, your podcast host, here with my good friend, Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. We are here. Boy, I said last episode that I'm really excited about this year as we are into 2026 now, with the topics that we have lined up. Now, I have probably a month or two worth of topics sitting here in front of me, and we're kind of going about these ideas and looking back and forth. But I really love these, and today's is one that I'm kind of surprised. We've talked about it, but we've never actually done this as a topic on this particular podcast. And it's one of the themes. First of all, hello, Professor Rick Plum. I already said you're a certified financial planner.
I wonder if you're going to include me in any of this.
One of those days where I'm going to lose the connection and it's just going to be me, and I'm going to say, I
had that happen years ago on a radio show, and it was, I just had nothing but dead air ahead of me. No callers could call in, nothing could go on, and it was not very many commercial breaks, and I just had to fill like 45 minutes of time.
What was I there yet, or was that on another station?
No, this was on a different station, and
it
was not. Hey. It was not the best of.
No, I've been there too, but anyway. So as I was saying, one of the themes that we do come back to on this show from time to time is the idea that financial planning and creating a strategy is really about balancing what you know with what you can't possibly know. We talked a little about that last week too. Planning for what you know and then hoping for other things that you can't possibly know about. Markets, of course, are unpredictable. Life, is unpredictable. And yet we still have to make decisions in our plans that will affect our income for years, actually for decades. It could be 3, 30, 40 years, something like that. I come back to my favorite. He's not a financial guy, but he's kind of a financial behavioral guy, Morgan Housel. And he came up with the line that I've loved for a long time: save like a pessimist and invest like an optimist. And this really captures, I think, perfectly what we try to accomplish with the bucket strategy. So in the short term, right, we expect trouble, not because we're gloomy, but because that's just how
it happens.
Yes. It's because that's how the world works.
Well, and it goes along with the other way of saying it: plan for the worst, pray for the best.
Exactly. I think that's just another way of saying that and putting this in investing terms. But over the long term, at least historically, history, I think, gives us every reason to be optimistic.
Yeah, and when we're dealing with creating plans, the assumptions, because the future is unknown, we can't guarantee anything about the future, but the assumptions of returns and expectations and things of that nature, we tend to be a little on the conservative side. Now, I'm not going to say that using a 7 or 8% long-term rate of return for what we call bucket number 3, the stock portfolios, it's not guaranteed, but given the historical long-term rates closer to the 10% range, we use 7 and 8% in the planning process. Now, we truly expect to get that 10% or better in the actual returns. But if we can get a plan to work with conservative or moderately conservative assumptions, then we're feeling pretty good about the overall potential for that plan, barring complete disastrous, life-changing events.
Which can
happen too.
Well, they can happen, and that's usually part of a plan as well. So I want to break down kind of what this saying means, this save like a pessimist, invest like an optimist, and how this shows up in each of the different buckets that we have designed, bucket 1, 2, and 3. Some people have a 4 and a 5, but the main thing is buckets 1, 2, and 3. And once you understand it, I think the whole strategy starts to click into place. So you kind of addressed it a moment ago, Rick, but how would you interpret that? Save like a pessimist, invest like an optimist, and why does this matter in the real world of financial planning?
Well, there's a difference, I think, between saving and investing. Saving is for near-term spending. Saving, obviously we're saving out of our paychecks for the 401k. We're saving on a systematic basis going forward, and we're creating net worth while we're still working. But once we get the saving is basically prying the money out of your wallet and getting it into some form of a holding account, investment account. And then it's a matter of, okay, what do I do with this ongoing savings? Now I'm turning into an investor if I've got time. So there's different ways to look at it. Savings by themselves are monies that you might need or know that you're going to need in the not too distant future. And because we need, let's say I need, $5,000 a month, or I want to have an emergency fund. The emergency fund is a good example of this. Emergency fund should not be in the stock market unless you can really afford to take that risk. But if I have an emergency that, the motor goes out in the car, washer and dryer blow up, all of a sudden I find out hail damage and I need a roof, and I need 15, 20 grand, whatever the number is. I need that to be 20 grand, not 14,500 because the market went down 25, 30%. I need it to be a real number. I cannot afford to take risk. And so I'm looking at that like I'm expecting bad things to happen. I have an emergency fund just in case something bad happens. I'm being pessimistic about the world. I have my emergency fund and I'm investing it in safer accounts that can't go down in value because of market conditions, because I know that the day I need the money will be the day after a bad market condition. And so I save looking at what's the worst that could happen, and I don't want the worst to happen to me. If I need the money, I need the money. I cannot accept a lower dollar value than what I already have. On the other hand, if I am an investor, if I've determined that I can be an investor, by the very nature of that decision, I have a long-term time horizon. You cannot be an investor with a 6-day time horizon. That's speculation. That's gambling, because it could go any way, 6 months even for that matter. But if I have a 10-year plus time horizon and I'm okay with some short-term volatility, even some big-time short-term volatility, like we saw in 2000 to 2002, like we saw in 2007 to 2009, like we saw very shortly in 2020, like we saw in 2022. If I, 20%, 30% down. So you look back at 2008, 2009, that was 45, 50% down on the market. I mean, that would scare the living bejeebies out of most people. But as long as I held on and I didn't panic and I didn't sell, as long as I stayed as an investor, and especially if I'm continuing to ongoing savings and investing going through this, long term, I'm thinking, this is going to work out really well. In fact, that volatility, I like volatility when I'm dollar cost averaging. When I'm putting money into my 401k, it's like if I see the market go down 2, 3, 4% in a short period of time, which it does quite often, I'm thinking, okay, when's my 401k contribution going to hit? Am I going to be able to take advantage of that because the market's down? Come on, whatever payday, let's get it in there now. So I'm using, even though the market's down, I'm saying, hey, this is good. I'm buying on. There's a sale at Penny's.
Yes,
I can buy it low.
As long as you have, and you have to have that time horizon, though, as you said, that time horizon has to be there.
I'm putting money in, knowing that I don't need to take it out for 10, 15 or more years. And I'm optimistic that over that period of time, I expect it to go down by 20, 30, 40% at some point during that period of time. But over the 15 years, I expect to get that 7, 8 or better. I'm planning on in my planning process 7 or 8%, but I truly expect to do significantly better. And you know what? I've been doing this for a long time. And there have been bad days. And I've, maybe every once in a while I pick a bad investment. Yes, it has happened. But my portfolio has done what it's supposed to do or better over any measurable, more than 3, 4, 5 year period of time. I've done very well.
Yeah.
Over some 2, 3 year periods of time, not so well. No, I didn't need to sell it.
And there is some luck involved in that. There are no guarantees over the short term. There's no guarantees over the long term either. But we can be at least somewhat confident, let's say, that long term we're going to be okay. So the whole idea of the short term pessimism is really built right into bucket number one. And I think this is what really.
Bucket number one is expecting the worst. I need money to spend, and I need it to be. If I need to spend $1, I need it to be $1. I cannot accept 90 cents. I will give up the idea that it could be $1.20 even to make sure that it's not 90 cents. Because if I'm going to spend $1, I got to spend $1. And so bucket number one is set up with short-term, not investing standpoint, safety, low volatility. Yes, we're trying to get return out of it, but return is not the top priority. Safety, or low volatility, and liquidity are higher on the goal metric than return. Obviously, we want to get as much return as we can for the other two parameters, liquidity and safety.
Well, this is so important. And this speaks to the theme of this episode, of course, and the whole reason why buckets exist. But if bucket one is so important, I can't understand why so many of these, portfolios that were designed to just take a 60-40 mix of stocks and bonds, we'll take some of each and we'll rebalance.
Well, because why would you settle for 3.5%, maybe 4% in bucket number one right now, when you can get on average 6 or 7% or maybe more in that average portfolio or that balanced portfolio? Why would you settle for a lower rate of return when you could have more on average? But it's always on average, and on average stinks because the old story, you could have your feet in an ice bank and your head in an oven, and on average you're a pretty good temperature. But your feet are freezing and your head is burning.
Yeah.
So you're going to get burned at some point using averages when you need to spend money. Now, if you don't need to spend the money for 8-10 years, balanced portfolios work really, really well. The problem is they use these balanced portfolios and they show you these historical average returns of 6, 7, 8, 9%, whatever they might be showing you. And they say, look what we've done. But if you then show it taking a distribution, taking money out of that portfolio, your actual rate of return that you as an investor achieve is significantly less than that historical average of a buy and hold portfolio. And in many cases, it can be negative. So not only are you pulling money out of it and depleting the portfolio, you're losing money because, yes, I needed $5,000 a month. And last month, I needed to sell 500 shares of something to get that 5,000 a month. This year, this time, I need to sell 600 shares because it went down by 25% or 20%. And I still need the $5,000, but I have to sell a lot more asset to raise that 5,000 than I did the month or two or three before. And that money can never recover. So when you are doing a distribution strategy, volatility is a major enemy, and it will hurt you. And even good years. I mean, if you look back, 2025 is going to end up being a positive year overall. But it wasn't positive all year. There were times when the markets are down, and if you're selling to get assets when the market's down, and if you're using a balanced approach and even using a 4% withdrawal, you are selling to get that 4%, because if 60% of the money's in bonds, the income from the bonds is not enough to give you a 4% distribution. If you've got 60% bonds and they're earning 4%, that means you're getting 2.4% cash flow on the portfolio. And so you've got to pick up the other 1.6% cash flow to get your 4% from some source. Where's it coming from? Some of it could be coming from dividends, but the dividends aren't enough on the 40%. The dividend may be a 2% to even a 3% distribution on 40%. That's only 1.2%, 8.8 to 1.2% on a cash flow using basis. It's not enough. You have to be selling something. And the values go up and down.
When I hear you say that, what you just said over the last minute or so, I would say I don't want to do it that way. I mean, I got to
You
have
shouldn't do it that way.
I've got to have a bucket one. And
Yes.
I don't understand why, there are still some people who do this whole, rebalance.
Because why would I accept a lower rate of return, even if it's only a portion of it? Because it's the right thing to do.
Well, and you're saying that it's all about that short-term rate of return.
For short-term money, for short-term needs, yes.
Yeah. 4%, you could get 6 instead of 4 of the short term. Well, see,
you might be able to on average, but they're not using short-term returns. Yeah. They're using average long-term returns to show you what you could have achieved if you'd stayed in it the whole period of time. But by definition, if I'm spending money out of it, I'm not staying in it the whole period of time.
And here's where that margin of error we've talked about before comes into. And that's what part of this is as well. Building in margin of error is being short-term pessimistic. So we use that for bucket one, expecting things to go wrong. You got recessions, downturns, unexpected events. That's a key part of designing a retirement income plan. Now, on the other side, we'll get to bucket two in just a second. But on the other side, long-term optimism is what drives bucket number 3. Now, long time horizons allow us to be confident. Now, we're not guaranteed, but we're confident that equities, which is pretty much what bucket 3 is, will do their job over the next 13 to 15 years. Now, what allows us to be confident? Just historically, we've never deviated from that?
Well, that's one of the things, yes. And the idea that we do need to keep the economy growing. We do need to have the world growing economy to make things work, not worse. So it's just that we have to have that optimism. But then that's also why we tend to use fairly conservative assumptions just in case, because we don't know what the future is going to hold. But yes, it comes back to, is now a good time to invest? The market's near all-time highs. Why would I want to invest when the market's at an all-time high? Well, because it may not be at an all-time high next week or next year, but over the next 10 years, 15 years especially, this is not a high. If we look back 15 years from now, look back 15 years from today, go back to 2010. We were in the middle of that was a downturn in 2010. Now we were starting to recover, but man, we should have been buying everything in those under the sun at that point. 15 years is that optimistic time horizon. Even 10 years, yes, there have been some 10-year time periods where the market, as measured by the S&P, did not produce a positive result. Most recently has been a few decades back, 2000 to 2009. But on the other side, if you were investing over that period of time, if you had just left it alone for that 10 years, if you actually had your 15-year period of time, you did pretty well. From 2000 to 2015, you did okay. But from 2000 to 2010, you didn't do so well. That's why we like having longer-term time horizons. On the other hand, if you are an ongoing investor, your 401k, things of that nature, that would have been a great time to be an ongoing investor. Even if you started, you can save $1,000 a month. So you started in January of 2000. You put your $1,000 in. It grew from January to February. Put another $1,000 in. It grew from February to March. You put another $1,000. Now you got $3,000 invested, and it kind of went south at that point. It went down, and your $3,000 turned into maybe $1,000 by a couple of months. But you've been putting money in, but you're buying in on those downturns, and so when it was down, by the time you got to 2006 or 7, your average rate of return was doing really well. Then we had another downturn, and you were buying again in the low times. Systematic savings does really well, especially over long terms where we have that volatility. But even somebody who retired, and we were working with buckets in 2000, somebody who retired in 2000, who had a 15-year bucket number 3, and who was not, and this is where diversification really comes into play, it was not 100% QQQ. It was not 100% tech, but had a good diversified portfolio with some value-oriented stocks, maybe some international stocks, a little bit of this, a little bit of that, a good diversified portfolio. By 2015, when they needed their bucket number 3, they were doing fine. They did their 7 or better, 8% on average, and they were doing just fine. Well, and if they'd followed value averaging, another concept of buckets strategy, they were actually probably doing some value averaging in 2006 and 7 before the crash of 2007, 8, 9.
I've heard of people say that I would rather have decent or fairly good returns over steady but fairly decent returns over a long period of time rather than shooting for the stars, because you just tend to win historically.
I don't disagree with that, but there's also a portion of the portfolio that I don't mind shooting for the stars with some of it. I mean, I'm not talking a major part,
well, that
10%
goes back to your
so.
time horizon, though. That goes back to your time horizon. You're not going to do that with the money that you need in the next 5, 6, 7, even 10
heavens
years.
No. I'm
So,
not going to be investing in anything that has volatility with money that I need to spend in the next 5, 6 years.
no, you might as well go to Las Vegas and throw it all on red
Or just, what's the lottery up to? $5 a ticket? Come on, baby, let's buy some lottery tickets. Might as well.
$5. Whoa, man.
I think one of them, Mega Millions, or one of them is $5 now.
Man, wow.
Or maybe that's just in California. It's probably cheaper in the rest of the states, just like everything else is.
Could very well be. Could be. So long-term optimism, and that's what's driving bucket number 3. Now, some strategies, and I put them. I wouldn't call them even bucket strategies because they're not. But there are some that call them a bucket strategy, and they say, all right, what we do, we have a bucket number 1, okay, and it's going to be 2 years, maybe 3, okay, and then everything else is going to be your next bucket, which is your equity bucket. So we have safety we're going to draw on for the next 2 to 3 years. And they're going to put the rest into equities. That's a 2-bucket system. Now, this is wrong on so many levels.
Well, it's a good start, but up until recently, the historical average of the downturn in the market was 1.5 years. It went down. It doesn't go down over 1 month. It goes down over a number of months in typical fashion. If we look at 2007 to 2009, the market went flat in early 2007 and then started dropping in 2008 and finally hit the bottom in 2009. It took a year and a half just to get to the bottom. So if I have 2 years worth of spending cash, all that did was it buy me time to get to the bottom of the market to sell out my equities to start paying, covering my monthly, nut that I needed to hit. It's a good start, but it's not enough. It's enough much of the time. It's enough for many of the downturns. The 2020 COVID downturn, that was fine for that. Mm-hmm. That was a very short downturn.
Yeah.
Even the 2022 wasn't too bad from that. You were probably okay with that. And those are the recent, and that's where people get the recency bias going. It's not enough for what we've seen happen and what we expect that could very well happen again, a longer term downturn. So 2 to 3 years of spending money before I go into my volatile assets, like I said, it's a good start, but it's for me, it's not enough.
Well,
now, that's up to you how much risk you're willing to accept.
In hindsight, it was good, but think about how nervous people were. They didn't know that the downturn in 2020 was only going to be, a couple of months. They didn't know 2022. For all they knew, it could be another 2008.
We were all afraid, literally afraid for our lives, let alone our finances.
2020, we were, absolutely. So we have a bucket number 2 here, and this is kind of I guess it's a transitional type of thing. Talk for just a second about how it helps transition people. I mean, it's kind of defensive and opportunistic. It gradually, I think, transitions from pessimism, short-term pessimism, into long-term optimism. But talk about why we need to have that bucket number 2 right in the middle.
Bucket number 1, bucket number 1, we talked about being 5, 6, 7 years. Bucket number 3, we talked about being 15 years. There's a gap. There's a little bit in the middle we haven't talked about yet. We don't want to go 15 years worth of money markets because we're missing out on some potential returns, and we don't need to be that pessimistic. On the other hand, we don't want to be totally optimistic that the market's going to just go gangbusters and have no downturns over the next 6 to 7 years, and we're going to just be all rosy. So we have that middle area. And this is actually where a balanced portfolio, or there's a lot of different. Bucket number 2 is the hardest because it's a longer-ish term time horizon where we hope we're blending into that optimistic range, but it's a short enough time period that it could really hurt us. And so we want something in the middle. There's lots of different things that can go there. historically, traditionally, it was a balanced portfolio. If we go back to the bad downturns, 2000, the balanced portfolios did lose money from 2000 to 2002. But by 2007, 7 years, they had recovered and had that 4 or 5% or better average return over the life of that time holding period. In 2007 to 2014, 2007 to 2009, the average balanced portfolio, according to Morningstar, I think I read this a couple years back, went down about 25%. And, that was over that first year and a half, 2 year period of time. But over the 7-year period of time from 2007 to 2014, they averaged 8 or 9% because they came back. You would not want to use them for a short-term time horizon. Now, and you don't want to use them for a 10 or 15-year time horizon because they don't earn as much as what you could earn just buy and hold on a 15-year period of time with a pure stock market investment. But balanced portfolios aren't always the issue because we saw this happen 4 or 5 years ago. Balanced portfolios, I think, went out of vogue to some degree because the balanced portfolio is a combination of stocks and bonds. The cash flow from the bonds is being used to reinvest, and so when the markets are volatile, it's buying half the portfolio or 40% of the portfolios in stocks being volatile, and that cash flow is buying in at that period of time. So you get a little internal dollar cost averaging going on. But we found that in, say, 2018, 2017, the bond component of the balanced portfolio wasn't adding anything positive. There wasn't any cash flow. I mean, 1.5%, maybe 2% out of that portion of the cash flow. And yet it brought with it had no upside real potential, but it brought with us a lot of downside potential.
Yeah, there was a lot of risk.
A lot of risk with no return in that area. So balanced portfolios in that period of time didn't fare well. And so we used other things in that category. Now they're back to being a more traditional style where we can get a little bit of juice from the bonds without taking significant amount of risk. And so balanced portfolios have come back in vogue. This is why you don't just set and forget everything, and you don't always use the exact same thing going forward every time you're doing it. You just enjoy monitoring and taking advantage of what's out there. But traditionally, a balanced portfolio fits perfectly in bucket number 2. But we want something that we don't have to be liquid for a number of years. We don't have to have immediate access to it. We can accept a little volatility. We just can't accept all the volatility of the market. And we're going to give up some of the potential return to the market because we're not going to have the same time horizon. This is all about time horizon. This is all about understanding the risks associated with what we're trying to accomplish with those dollars. We are identifying when we're going to need that dollar and backing that up with the time horizon for when we will need that dollar.
Yeah, and this what we show from bucket 1 all the way through the end of bucket 3 is the transition from the short-term pessimism to the long-term optimism. I mean, if you compare somebody who just stuck money into the stock market and I guess maybe dollar cost average their way in, but never took anything out between, say, 2009, maybe, early 2009 and the end of 2024. There's a 15-year, maybe that was 16 anyway. I don't know, 15 years, something like that. I mean, the results just based on returns that we've seen were phenomenal. I mean,
it was if you take a buy and hold investor from, June of 2007, push them forward 15 years. And a buy and hold investor, March of 2009, the bottom of the market, push them forward 15 years. The rate of return obviously would have favored the investor that went all in March of 2009. Not that many people wanted to do that in 2009. They were running for the hills. But the 15-year average return is not like the difference between a 5 and a 20% rate of return. It's the difference between a 12 and an 11% rate of return. When you've got that long-term time horizon, everything kind of tends to come back. The day you invest is not the most important thing. It's the time horizon that you're going to stay in is the important thing.
Yeah, it's almost indistinguishable from magic when you go from 2009 to 2024, 07, whatever it was, after 15 years, over the last 15, 16, 17 years. It's quite amazing what you wind up with. So this is why we talk about this. You said time horizon is the most important thing, and it absolutely is. We are confident over a long period of time and define the time horizon. We said 15 years is best, 12 to 15 years. We like 15. 15 years, if you can buy enough time to get you through those 15 years, historically, at least, you've done very, very well. And that's really why we say invest, save like a pessimist, and invest like an optimist. And I like what you said early on in this, Rick. You made the you distinguished between saving and investing. Those really are two different things. Saving, I'm just going to collect the money, probably need it now. I'm not going to invest anything that I need.
Investing entails accepting volatility.
Yeah. And
saving says, I don't want volatility. Now, I will say that there's kind of two different definitions. Saving is also the act of, as I mentioned before, using the crowbar to get the money out of your wallet and get it away from today. The money in your wallet is for today's spending.
Like literally today.
Yeah. And so if we can take it out and then turn it into investing dollars, then that entails not money that I'm going to spend tomorrow, but money that I'm going to spend next decade or two.
Yeah, exactly. These are the kinds of conversations you really need to have with a qualified financial advisor. And this is what Rick, Professor Plum, and all the advisors at Lucia Capital Group work through with their clients every single day. Maybe you're wondering if you have enough room for error built into your plan, like we talked about, or whether your income strategy can potentially withstand the next downturn. Well, I think right now is the time to find out. Remember, saving like a pessimist, it's not about fear. It's really about being prepared so that you don't have to panic when life throws you the curveball, as Rick said, or a beanball. That's more like it sometimes.
Dadgum spitball coming at me.
Right, exactly. Yeah. You want to give the advisors a call at Lucia Capital Group, 800-644-1150, 800-644-1150. Professor Rick Plum, as I said before, heads up the financial planning department. Everyone else, they all collaborate on plans together, but Rick is in charge of those. You can go online as well to luciacap.com. LUCIACAP.com. You'll find information on everything we talk about here, along with the free downloadable guides. Don't forget that. You're looking for a Social Security guide, estate planning guide, retirement income, bucket strategy guide. It's all right there. You can just type whatever topic you're looking for into the search bar, download it, and you can enjoy your new favorite reading material. And as always, make sure you subscribe to the podcast on Apple Podcasts or Spotify. Listen to and download each episode, because I really do. I believe you'll come away with something useful every time. Speaking of time, we're out of it. We got to run. I appreciate this. For Professor Rick Plum, certified financial planner professional and accredited wealth management advisor, I'm your podcast host, Johnny Dean. Thanks so much for joining us. We will talk to you all again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. All performance referenced is historical and is no guarantee of future results. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. Stock investing includes risks, including fluctuating prices and loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. Bond yields are subject to change. Certain call or special redemption features may exist which could impact yield. The S&P 500 is a stock market index tracking the stock performance of 500 of the largest companies listed on stock exchanges in the United States. Indexes are unmanaged and cannot be invested indirectly. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. A value averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities, you must consider your willingness to continue purchasing during periods of high or low price levels. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. Rick Plum is a
registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC.